Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And with me are our three regular co-hosts, Will, Mark, and Ramsey. Good morning.
Good morning. How are you?
All right. Hey, listen, great day. Sun's at least, some undisclosed location in Westchester County. The sun is starting to promise to have a nice day. But more importantly than, good weather and spring coming, Ramsey, we've got a great guest here. Do you want to do a quick intro?
I'd be happy to. So want to welcome to our podcast today, Wade Pfau. Wade has been a real sort of consistent and strong voice in the retirement space. He recently published a book called Safety First Retirement Planning, and it really highlights the role of guaranteed income in an efficient plan for retirement. And we thought that given our audience, it made a lot of sense to meet him today. So Wade, I'm going to let you kick it off. Tell us a little bit about, first of all, what are the various businesses you're in? You're affiliated with an asset manager. You write books. You do a lot of academic work. Tell us about that, and also tell us about how you started out in the retirement space.
Sure. Well, thanks, Ramsey, and thanks, everyone. So my day job, I would say, is I'm a professor of retirement income at the American College of Financial Services, which trains financial advisors, and I'm the head of the RICP program there. That's the Retirement Income Certified Professional Program for financial advisors. I do also work with a registered investment advisory firm, McLean Asset Management. And my website, retirementresearcher.com, is technically an RIA firm as well, though we don't have clients with that. Beyond that, you're writing books, doing just different things along those lines keeps me pretty busy. And research on retirement income planning.
Yeah, and Wade, maybe just tell us, how did you find your way to retirement planning as a specialty?
Well, I was living in Japan and I was working as an economics professor and doing research about the pension systems in emerging market countries. Wanted to move back to the US, didn't think that was particularly marketable, so started just looking around and stumbled into personal financial planning and retirement planning because it's still a relatively new field. The first PhD program in financial planning didn't really get going till around the year 2000. So I found my way into that and never turned back because it's such a hot area, and academics usually don't get the research read, but in retirement planning, people are interested in it. So it's a good career move for me.
So, what are the, what are you finding as you take this journey and educate the world about retirement planning, particularly your principles? What do you think? What are some of the things that are most poorly understood? I mean, you're carrying the mantle of the role of annuities, and annuities have had an uphill battle in a lot of ways in terms of sort of raising the banner. What are some of the things you think are most poorly understood, and what can we do to change that?
Mm-hmm. Well, right, and to be clear, so the investment firm that I work with is part of this side of the spectrum that traditionally has been anti-annuity because it's the fee only, no commission, just charge your client and so forth. So that's where I got my start. My background is in investments, but I really became concerned with how the investment world approaches retirement income with things like the 4% rule of thumb and so forth. And the first study I did, what got me going with retirement planning was I had a global market returns for 20 different countries to look at. And I was curious, did the 4% rule work with other countries' data? And that 4% rule concept, it worked with US data and Canadian data, and that's it. In the other 18 countries, it didn't work. And if you look at the 4% rule around the world, it only worked about 2/3 of the time internationally.
Okay.
So that was my beginning of all this, looking for alternatives to that type of approach. And then slowly coming to learn and understand how the power of risk pooling through an annuity, it's actually quite competitive with the stock market. Like in the early days, the discussion was more, well, you're going to give up your upside, but you can at least lock in your basics with an annuity, and that's the way to go. But I've transitioned away from that because risk pooling is actually quite competitive with the risk premium from the stock market. A great way to fund basic retirement spending with less assets and to have the protection behind that.
Okay, wait, there's a lot packed in there. Okay.
Big nugget there. Yeah.
Let me kind of wait. I've been planning. How many clients have I worked with, and I baked that 4% rule into their plan. I mean, Mark and Will, what percentage of plans do you think are sitting on somebody's desk here with a 4% assumption on it? I mean, do you think 50, 60%? What do you think?
I think that's probably a good estimate. I think, for the last several decades, that's been kind of the number that people have been using, the Monte Carlo simulation that projected that.
Yeah, standard bear for, placeholder for the amount you'll be able to withdraw. So yeah, I think it's important to take a look at it. And Wade seems to have, put his finger on that pulse.
Yeah. So Wade, so it wasn't 4%. Was it maybe like 3.75%? I mean, what's your study say?
Well, yeah, I do update it from time to time. And so something on my website, I have this dashboard where it's most recently been updated for April 1st. And looking at different strategies, looking at how much risk tolerance somebody has for the potential for depleting their assets. But in trying to come up with assumptions that are fairly closely aligned to what the 4% rule is assuming, but accounting for the low interest rate environment, my current April 1st estimate is 2.29% as the safe inflation-adjusted spending rate that should protect spending for 30 years with a 50-50 stock bond mix.
I'm sorry, 2 point what?
2.29% should give you a 90% chance that the
Ramsey, 2.29%. Did Wade just like cut my retirement plan in half here?
Well, that's just it. One of the most interesting things to me about finance, and I've been in it for 3 decades basically, is that there's a very high dependence on rules of thumb, and those rules of thumb often are not sort of reevaluated quantitatively. They're just sort of used as sort of a standard. So this is a perfect example of that. And and Wade, I mean, look, this is a fascinating point, and I think it gets people's attention when they see it, and I think that's very healthy. I think there's 2 things that I'm curious about. One is, like, what are some of the things that were kind of a stretch in terms of how the 4% rule was calculated in the first place? So, for example, like, what are some assumptions? Are there assumptions around like taxes or fees and things like that weren't in there? Or even before we get to where we are now, like, what were some of the deficiencies just to start?
Mm-hmm. Well, one big deficiency to start with is just the 4% rule creates the most risk because it tells you to be 50 to 75% stocks in retirement, and then it never has you adjust your spending. So it's the rule that's going to potentially get you into the most trouble if there's ever any sort of market downturn. But it has a number of simplifying assumptions. It's based on looking at different 30-year periods in the US historical data. It assumes investors earn the index market returns on the S&P 500 and an intermediate term government bond index. So there's no investment fees. There's no taxes. It's assuming if you're taking from an IRA, you just pay taxes out of the 4%. But if your money's in a taxable account, the ongoing taxes on interest and dividends are going to eat away at the ability to fund a spending level at that amount. The longevity, I mentioned it specifically for 30 years, but increasingly people in their mid-60s need to look beyond 30 years, and that's going to lower the withdrawal rate. It's based on US historical data, and we've never seen interest rates as low as they are now. Market valuations are no longer at peaks after the downturn we've experienced, but they're still on the high side at the same time that interest rates are lower than ever. And both of those factors also suggest a greater concern about the 4% rule in terms of, just because it worked historically, we haven't had this kind of situation before to know that it will work for retirees today.
Hey, Wade, quick follow-up on that point. Across the industry, are you seeing economists and other planners and financial professionals kind of challenging the status quo with respect to the 4% rule?
Yes, academics were never fans of the 4% rule because there's a whole economic theory completely divorced from the 4% rule. And then in the mid-1990s, the 4% rule just popped up. And like William Sharp, a Nobel laureate, has explained why the logic of the 4% rule, it's really so inefficient for trying to plan retirement, because if you don't have any protection from a worst case scenario, but the idea is you just spend less to protect yourself from a worst case scenario. And if you're not in a worst case scenario, if markets do okay, you're just dramatically underspending and leaving such a big legacy at the end, completely unintentional. There's much more efficient ways to spend down assets than the logic of the 4% rule. Moshe Milevsky at York University is really the leading researcher in retirement income. He also just views the 4% rule as just some silly thing that came from practitioners that has no sort of theoretical basis or reason to use in practice. Larry Kotlikoff at Boston University also really criticizes the approach of trying to meet a wealth target to fund 4% and not really considering the entire financial picture as part of that.
So I probably should have been reading more, Mark. Why is it that this 4% is so baked into advisors' heads like mine?
I think, going back to the point that Wade mentioned a moment ago, it's been kind of around since the 90s. And I think people just kind of latched down to that. I also think that, we're still in the infancy of distribution planning. For so long, the marketplace has been focused on accumulation planning. And I think it's just that standard rule of thumb that people latched onto that kind of just fell and stayed in place. And I guess, one quick follow-up question, Wade, for you, is you mentioned, your current assumptions based on April 1, is at the 2.29%. How frequently do you update that drawdown percentage, and what are the main driving factors into what you come up with in terms of that determination?
So I started this dashboard, and I think it was in 2015. I meant to do it quarterly or monthly. I got pretty lazy about it in the past, but now I've made it easier to update. I may not always do it monthly, but at least quarterly, I hope in the future, where I'll try to be more regular in updating that, since it is quite important right now. When markets are always going up, people don't pay as much attention to this sort of thing. But when we see the volatility return, that increases interest. And so I should be more active in updating it.
And is that something that's dynamic regardless of when you start that drawdown, or is that somebody that would be starting a drawdown today, like based on those numbers?
Well, so there's all kinds of assumptions in the 4% rule. And so the way it works, that would just mean for somebody who is retiring April 1st, or like today, that's the kind of spending strategy that should be sustainable for their retirement. Now, if they retire a month earlier or a month later, this whole logic of the 4% rule might give them a different number to use. But the idea is you play this game of chicken with the 4% rule. You're always going to spend the same amount and never make any sort of adjustment along the way. And so it really is dependent on where the markets are on that date of retirement.
Interesting. Well, okay. Another word you used, Wade, that is another kind of loaded word is mortality pooling. So I don't know, Ramsey, what do you want to dive in there?
Sure. So I often find myself in these conversations with financial advisors, even consumers, where it's a discussion about what are their alternatives in terms of creating income in retirement. And the answer I get a lot is of sort of DIY type solutions. Well, I can just replicate this with bonds, or I can just replicate this with dividend stocks, or which is even a worse idea. But let's just stick with the bonds. The bonds analysis. The thing that I find that people don't understand is, one, that they probably overestimate their portfolio management skills with respect to getting a diversified portfolio of bonds and everything that takes, and to have to do that, with perfection over the arc of their lifetime, from high level of competence at 65 to diminishing competence later on. But beyond that, it's very hard to get people to visualize the role of mortality credits. And so there's a great chart that at the very least we're going to make sure is in the show notes maybe we're gonna try and pull it up here, but even if we don't, like, would love to talk, Wade, about your thoughts about just that tension between bonds versus income annuities, and how can we best explain to people, what the difference is and what the value is there.
And I'll pop this chart. I'll pop this up, and we will stick it in the notes if listeners want to see this. Right, Ramsey? This is the chart you're talking about.
Let's do the other one. Let's do the
the
one with the bars.
Hold on a second. Let's see if we can.
So, Wade, you can go ahead and start, and then we'll.
Yeah. Okay. Sure. Yeah. So there's basically 3 different ways you could fund retirement. And the starting point is this bond ladder concept, that you just have bonds maturing each year to the coupons you're getting with the future bonds as well as maturing bonds. That's going to fund your expenses for the year. And so when you do that, your sources of spending are the principal that you put into that bond ladder as well as the interest you're receiving. Now, if you want to spend more than that, the whole logic of the 4% rule, it was, you can't go with just bonds. You have to use at least 50% stocks in retirement. And you're trying to fund a higher spending level through risk premium, the idea that stocks will outperform bonds. The annuity approach, though, it's very similar to bonds in that the insurance company is effectively building a bond ladder. They have these bonds that they're holding to maturity, providing that spending power linked to the expenses they need to make. But the insurance company can allow individuals to spend more than anyone can spend with bonds if that person's worried they might outlive their money. So the whole idea of retirement planning is not that you just plan to live to your life expectancy, because there's still a 50% chance you'd live beyond that age. And so if you have to stretch your money out to a later age, it forces you to spend less. And that's kind of the idea in this chart. You see, like, if I'm going to use bonds to fund my spending through age 100, with the assumptions behind this chart, you could spend about $33,000, $34,000 a year. Now, the annuity lets you actually spend more than that, because the insurance company, some people will live to age 100, but not that many. And if I'm, as an individual, trying to figure that out, I just have to assume I'm going to potentially live to 100. But the insurance company can rely on the distribution of what that looks like, that some people will only live to 70, some live to 75, some live to 90. And so they can pay everyone at a level that's more closely linked to their life expectancy, that average age people will live to. And since in that case, they can allow for a higher spending level, because those who don't live as long, some of their premium will help to subsidize those who live longer. Now, there's this idea that if people view annuities as a gamble, that if I don't live very long, I'm somehow, the insurance company wins at my expense. But that's not what's happening. It's the people who live longer that, well, they win at my expense. But nonetheless, since I don't know how long I'm going to live, it allows me to spend more. I can enjoy a higher standard of living in retirement. And that's what the yellow part of this chart is showing you. The yellow area is effectively this risk pooling, mortality credits, the subsidies that the risk pooler are able to provide that allow for a much higher level of spending than I would otherwise be comfortable with bonds, if I'm trying to kind of self-manage that longevity risk and assume I might live a long time. And that's where I said that this risk pooling is really competitive with the stock market. Well, then we can look at, can an investment portfolio outperform just bonds alone by enough to match what the annuity can do? And the answer is, well, maybe, but it's nowhere near as definite. This yellow area is big. The extra spending power of the annuity is quite large. And that's a source of spending that investments can't provide.
Hey, Wade, just a quick point of clarification on the graphic. Are you the hypothetical with the annuity, is that a GLWB or is that a SPIA? What's your basis for this hypothetical on the annuity?
So this is a life-only SPIA, and it's just, I price it out myself. So but it actually is fairly close to, well, at the time, this is from my book when interest rates were a bit higher, but at the time it was fairly close to what commercial annuities were looking like.
Yeah, and to Ramsey's point, this is exactly why I can't I can't run a bond portfolio to hedge against how long I'm going to live or not live. Correct. Yeah. What are the cautions? I mean, well, okay, so I look at this. Gee, maybe I should put all my money, 100% of my money in annuities. Well,
Yeah, I
what's
think I think that's what, I mean, that's why we've talked many times about this. It falling back onto the objectives. If increased lifetime income, this graphic shows the differential there in reliance upon a bond portfolio, or using a SPIA. So it does show quite a differential. But it's always, it comes back to the same thing that we've talked about many times on this show, on this podcast, is eyes wide open. Clients need to understand the differences here, the limitations with a SPIA, the challenges with a bond portfolio, et cetera. So I think all those things should be discussed so that folks understand why they're making a certain choice and what their objectives are. And maybe some combination thereof is also something worth considering as well. So
yeah,
those are all
that point, Will. I mean, obviously, you've got the component of a SPIA, which has less flexibility than a GLWB in many of the products available today. And what I find very interesting is, even if you go back to the utilization of a 4% rule, which we know is no longer the norm, and if we're looking even at now at a two and change, starting at age 65, most of the guaranteed lifetime benefits are going to pay out well above even the 4% guaranteed for life from the initial principal investment. So I guess my underlying question is, why wouldn't everyone have a piece of their portfolio in something like this if they can guarantee a lifetime income that's greater than a spend down strategy that's not guaranteed and subject to unforeseen things like market volatility?
Mm-hmm. Yeah, and it's about, annuities are much more efficient than bonds. And kind of the punchline of all this is bonds are the least efficient way to fund a spending goal. That at least with stocks, you have some upside potential as well. So why don't you look at, just instead of trying to fund in a retirement with a stock bond portfolio, allocate some of those bonds into the income annuity to fill an income gap, to cover the spending need in a more efficient manner. And then because you have your spending protected with lifetime income, now you have more risk capacity. Now your lifestyle is not as vulnerable to a downturn in the stock market. And so to the extent that you're comfortable with it, you can invest more aggressively with those remaining assets. And so you have instead of having the stock bond allocation that we think about with pre-retirement, it's more like a stock annuity allocation for retirement, where the annuity is funding your spending. And then you can have this aggressive investment portfolio to fund more discretionary types of expenses, or the source of liquidity, or just legacy and so forth on the side outside of the annuity.
Yeah, one of the trends that we're seeing obviously now in the United States is the shift over from defined benefit plans to defined contribution plans, and less individuals going to retirement have defined benefit guaranteed pension plans. You mentioned when you started your career, you started in Japan, really studying their pension program over there. Any key takeaways that you learned from that dynamic that you can bring foresight into kind of what's going on in the U.S. today?
Mm-hmm. Right, and the U.S. is somewhat unique in that there's been such a dramatic shift away from a traditional pension that in the U.S. was traditionally company pensions. They were annuities. The employer managed the longevity risk and the market risk by giving people a defined pension benefit based on their work history. Now we've transitioned to defined contribution, where I know how much I put into my account, but I have no idea how much I'm going to be able to get out of my account in retirement, because it depends on how long I live, and it depends on future market returns, neither of which I have any control over. And so annuities are effectively a way to buy a pension that is still much more common in other countries, to pool and to manage that risk so that I have a better sense of how much I'm going to be able to spend, rather than having to be so vulnerable to what happens in my specific case, which ultimately, that's the logic of the 4% rule. It's, I don't know how long I'm going to live, so let's just assume I'm going to live a long time. Let's assume I get bad market returns, and let's spend less so that I can feel comfortable I'm not going to outlive my money, while there's still no guarantee behind that. Well, why not just pool that risk and spend at a higher level and not have to worry about that risk? which is what pensions do.
Yeah.
Right.
Oh, well, just to stick with the chart just a little longer, and think about the differential between the yellow and the purple or the green. Okay, presuming I bought this, the choice would be buy the single premium annuity now, or versus sort of keep this portfolio in place. What would happen if suddenly we're not Japan, and I'm not sure exactly what'll do this, but 5 or 6 years out from now, interest rates start to spike. The yellow would get smaller, in fair disclosure, correct? The gap between the green and the blue, the yellow would be smaller over time. Would I be reading this correctly?
Yeah, there's this misconception that like when interest rates are low, it's a bad time to buy the annuity. But you're right. Actually, when interest rates are lower, that yellow, the gap, the differential between these two is bigger. At higher interest rate levels, the annuity is always going to support more spending than the bonds.
Correct.
But the differential between them gets smaller. So
Now,
you're getting a bigger differential in a low interest rate environment.
Right. So this is fascinating. What other questions do we have for Wade?
Oh, there's so much here. I want to just revisit one particular thing you pointed out. I think is super important. Is when people think about an annuity as a quote unquote bet, and they think it's a bet against the insurance company. I think that sort of paradigm, that perception, I think is really not a good one. It's really you and other people, and really the insurance company is essentially just the referee and the provider of tail risk if they got the math wrong. But fundamentally, it's you and the rest of the pool. And the role of the insurance company is to make sure the pool is well diversified, and that it's supported, and that that payments can be made out in some cases many decades. And so I think that is a very, very important point. And I also think we got our sound bite, which was I think it was bonds. Bonds are not an efficient way to fund a spending plan. Did I get that right?
Right,
Wade?
they're the least effective way.
The least
That's
effective
right.
way. Yeah, that is.
We got the pull quote, right?
Yeah. So I guess my question is sort of where do we go from here? I mean, in some ways, all the reasons that we cite in normal times for the value of an annuity are being shown on full display in the current environment. So in some ways, you'd think this would be the golden age of annuities. I mean, the lower interest rate environment, obviously, even given these advantages, does create some headwinds. But in terms of the basic use case, which is risk management, stability, all the reasons that an annuity is part of a portfolio. And I'll just say that, to address Will's comment earlier, my view is that this is an answer for sort of 30% or less of your portfolio, generally speaking. But my question is how do we get more people to understand this? And are you seeing a change in the way people are discussing the role of annuities with you? Because you talk to a lot of people, you do a lot of seminars, you were on the road a lot. How is the visibility and interest in these solutions changing?
Mm-hmm. Yeah, I used to be on the road a lot, so not getting out there as
much anymore. You're on the virtual road now.
But right, historically it's always been the case that there's this inverse relationship between the stock market and annuities, that when the stock market's always going up, people forget about the idea that markets can go down, and so they think the investment portfolio is all you need. You don't really need the annuity. But when there are dips in the stock market, that usually leads to a pickup in annuity sales, as people are remembering, hey, markets are risky, and after the run-up, I may be able to lock in my goals and take this risk off the table, not have to worry about it anymore, versus staying in the market where I may be vulnerable to going from having a successful plan to not having a successful plan. So there's definitely a growing interest in annuities whenever there's any sort of market volatility. And that's what I am seeing that today, growing interest in general about many different approaches that are more holistic and go beyond just this idea of I'm going to use an investment portfolio to fund all my financial goals in life.
This is great. Wade, first of all, thanks so much for spending time with us today. as Ryan just said, I mean, we only scratched the surface here of a lot of the interesting work you've done. We've, read, some of your books and your articles. Tell us, I guess, first question, how do people find you? And, what's the sort of latest, piece of work that you may have that people could, buy or find on the web?
Mm-hmm. Well, on the web, so my website's retirementresearcher.com, and we put up a site. We have a weekly email list that people are welcome to sign up for, and at retirementresearcher.com/join, you can sign up for that list and also get a download of this retirement dashboard I'm talking about, where it shows
Excellent.
sustainable spending with different strategies today. And then the book I've written that's the closest to everything we've been talking about is this Safety First Retirement Planning. And I have a few other books as well. They're all at Amazon if you'd like to just
okay.
that.
Well, excellent. Listen, thanks for your time today. And
Can I just say one thing? Can I just say one thing? Sorry. So for many, many years, when people ask, is there, what book should I read? I usually would point people to A Random Walk Down Wall Street. I think that's one of the most important personal finance books of our time. I don't really point to too many other books. But now the other book that I point people to is Safety First Retirement Planning. So, I think it's a really important book and highly recommended for everybody.
Yeah, well, thank you, and everyone, thanks for joining us again here on the show. Now, we actually are going to put a special treat at the very end. Mark, you've had some great Facebook broadcasts here over the last couple of weeks. Just tell us briefly what you're doing.
Yeah, I've had a lot of fun with it. I used to play in a band years ago, and watching all these musicians out there doing the stay-at-home concerts, and I think it's people looking for things to do when they're home. So I started posting a couple of weeks back, just some songs. Just started recording some songs, and it's been great for me, kind of getting back into it. I haven't played in a long time, so it's been fun for me to do that, and hopefully I can share some music. I think music is a great common language, universal language for everybody, and it's something that just gives everybody a little bit of enjoyment. So it's been a lot of fun.
All right, so we're expecting in the future a Grateful Dead song about guaranteed income. So
I think
we'll look through their prior ones. All right, everybody. Hey, thanks for joining. Will, Mark, and Ramsey, and Wade. Special shout out to you. Thanks for joining. Hope to have you back here.
Let's have you back.
Yeah.
Thanks. Thank you.
Thanks, Wade.
Thank you very much.
Thank you. Take care.
Okay.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.
Down last night, Lord, a good night, yeah.